Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, May 28th, 2023. We've got another great show for you this week as members of the media, academia, financial services, and government are standing by to help break down all the news and events for the week. So sit back, relax, enjoy this episode of BRN Sunday. Well, we're going to kick off the show as we always do with a look at what's happening on Capitol Hill. And here to break everything down, David Levine, Kevin Walsh, both are principals with Groom Law Group. That's an employee benefits law firm based in Washington, D.C. David, Kevin, great to talk to you. Thanks so much for joining us on Memorial Day weekend.
It's great to be on the show, Jeff. I think, listeners, hope you have a relaxing Memorial Day weekend. I know I'm going to try to get in some meditation if we're trying to do the Asians.
Yeah, and what the audience doesn't hear is the fact that I blew it and I actually combined both of your names in the in one of the outtakes. So, David, let's start with you because I know there's a lot going on in the industry, and I know you want to talk CITs. We're going to get into this. This is a big discussion going on right now.
Well, I want to talk aggregation, elevation, and collectivization, Jeff, today. Okay. So I can just hit enough of the buzzwords here. But yeah, we're talking about CITs, collectivization. CITs, collective investment trusts. I know we've talked about it with you many times. The quick 10-second basics. They feel like mutual funds, but they're regulated by the Office of the Controller of the Currency or state banking regulators. They have less regulatory complexity, which means they are often cheaper. That's a short version of it.
Yep.
There are two issues to talk about this week that Kevin and I thought would be good to hit on. The first one is SEC Chairman Gensler, in a speech just this week, made some comments about concerns, and I'm paraphrasing here, sort of gaps or exposures, because CITs are not necessarily under the regulation of the SEC, and concerns about how they operate and risks to investors. I think there's some real debate on that. I think people who are in favor of CITs, and we work a lot with CITs, believe that there really isn't that much gap. You've got the OCC, who is a real regulator, as are state banking regulators, who are real solid regulators. And there's also so much focus and transparency and systematic items like clearing through NSCC and all these different entities that I think the industry belief is that CITs work well, they're practical, they're effective, and they're helping people save for retirement in a cost-effective manner. Now, the SEC under Chairman Gensler has taken some more positions that we know not everybody agrees with. Their view is that this is consumer protection friendly. I think even as a consumer, I may not agree with all of it, but I think this is something to watch because the SEC's focus on CITs and concerns they may have could have a significant impact on the retirement system. A second thing that's out there that we are focused on at this point, we've talked about it with you before, is the legislation that we know was pushed as part of the Secure 2.0, but it didn't make it about CITs and 403Bs. For instance, I know NAGDA, the trade group, really took an active role in that. What happened is at the end, it dropped out. There were some concerns, also pieces about beyond CITs, but we're not going to get into that. It got into the mix, and there were some different views on that. Here, legislation moving forward with CITs and 403B and other investments is clearing its way slowly through the House, and the question is it going to go forward? There's a long way to go because we know that there are some who are still actively campaigning against the use of not necessarily CITs, but other investments in 403Bs. As I said, my view, broad, open to all is good, but when you bundle things together, sometimes people come out. So those are two things that are moving forward, which I think are both positives and also potential things to watch for in the land of CITs. But I know my friend Mr. Walsh may have more to add on the SEC, so I'll toss to him.
Kevin?
Yeah, thank you, David. I mean, I think one thing we've got to watch out for is what the SEC is looking to do with CITs. And some of where we see that is with respect to a proposal from the SEC that, Chairman Gensler spoken about a fair amount of times on swing pricing. Um, and what the SEC has proposed essentially is that in order to get that day's price on the trade of a mutual fund, you'd have to have your order, delivered essentially to the mutual fund family or to a clearinghouse by 4 p.m. And it's problematic for CITs, and it's problematic for the retirement industry as a whole for a number of reasons. With respect to CITs, I think one of the more obvious issues here is that if you're a CIT that's a fund of funds, one thing that happens today is, the CIT trustee may get in all the orders that come in during the day, bundle them, batch them, figure out, if it needs to rebalance. And then at the end of the day, it'll submit an aggregate order to the mutual funds to buy and sell and get that day's price. And, typically that bundling occurs after 4 p.m., but it's based entirely on actions that occurred before 4 p.m. So there's not really an opportunity to take advantage of late trading. Essentially, all that's happening is ministerial work after 4. In order for, CITs or record keepers for that matter, to have all that information in place before 4 to get it in, the time that a retirement plan or a retirement plan participant would have to get their order in would need to be moved back substantially. We've heard folks say, possibly the cutoff would be noon. We've also heard folks say possibly the cutoff would be way earlier than noon. And, that puts market participants on the East Coast in a tough spot. It puts plan participants on the West Coast in almost an impossible spot. And so I think we're going to have to watch what the SEC does with swing pricing. We know they'd like it to apply to CITs as well as mutual funds. We know that as it's structured right now, it can mess up the operation of fund to funds or CITs that invest in mutual funds. And really, it's something that could impair the ability of retirement investors to make decisions, in the afternoon, or, should there be signs that there's a market crisis or a debt crisis or a debt ceiling problem that you don't act on early.
Gentlemen, let me just pose, like David, not going to put words in David's mouth, but parity in the retirement industry is really important. Parity in terms of the investment vehicles being offered, right? In the 401k and 457 world, that CIT is available. And so that's very attractive and for a lot of plans to take advantage and lower fees. And so from my perspective as a reformed advisor, now broadcaster, that sounds very attractive. But as you both point out, there are attractive for 403B plan participants, but there are the technological and oversight challenges that I think a lot of people maybe aren't aware of that you guys are illuminating. So, that's just my perspective, and give you guys a chance to respond to that. There's a lot that goes into record keeping and administering retirement plans and investment vehicles. And this is an example. These are examples of challenges.
I think that's right. I think sometimes the SEC looks at CITs and looks at, the way that they're regulated and sees they're regulated slightly differently than a mutual fund would be regulated. But what the SEC fails to spot is that when you have a collective investment trust, you've got ERISA fiduciary protections in place. And ERISA fiduciary protections don't pass through quite the same way with respect to a mutual fund. So, there's different protections, but CITs offer ERISA protections instead of some, more complicated disclosure regimes or more complicated rules that would impact the fund in other ways.
And David, I think, David, you were going to weigh in. Go ahead.
Yeah, I'll agree with Kevin. I think ERISA provides a lot of protection. It is the very strong protection. The SEC does great work, but ERISA does a lot as well. But it brings us back to a macro point. I think maybe that's a great way to end us on a holiday weekend, Jeff. You make the point that our system takes a lot to function. Sometimes it seems really easy whether you're an employer or participant or anybody else, that, hey, I put money in my 401k and it's there. But the pieces are complex and it takes resources and effort to make things work. And I do worry that sometimes efforts to change one piece, while guided by good intentions, can have dramatic negative impacts in terms of cost and performance and just outcomes for participants. So I think this is a great example of why people need to look at the holistic picture as we sit back on this holiday weekend.
And last question before I let you guys go. Let's just process it gets, I think it just got approved by the committee or the subcommittee, right? What's the process to get CITs?
Oh,
Go
it's
ahead.
a long road to hoe here. Because it has to get to the House, it has to get to the Senate has to agree. You have to have an identical bills. Let's put it this way: is it progress? Absolutely. But is it happening tomorrow? No way. Right now, as of the moment we're recording this, we don't even know if there's going to be a debt ceiling extension. So let's see what happens, and we'll figure it out.
Well, here they are breaking it down as usual, giving us the inside baseball and expert analysis. Legal Eagles, great to talk to you as always. Thanks so much for joining us, and we look forward to having you back again on the program next week, gents.
Thanks for having us on, and happy Memorial Day, listeners.
Happy Memorial Day, all.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions, and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Now we're going to talk markets on this Memorial Day weekend. Joining us on the line, he is the lead anchor for the TD Ameritrade Network, Oliver Rennick. Oliver, thanks for stopping by the program this morning.
Absolutely, Jeff. Always appreciate it.
Well, we appreciate it. Oliver, what I figured we would do, I'm going to give you a topic and let you kind of not go off, but, just let you sound off on your thoughts about that. So let's start with some job numbers. I think this week we saw some positive job growth. I want to get your reaction to that and market reaction.
Yeah, jobless claims did drop after several increases the past couple of weeks and really the last kind of month and a half, couple months. So to see jobless claims go back down was good. Probably one of the economic highlights. The other economic highlight was inflation coming in a little bit warm on Friday. PMI services were downright hot on Tuesday. New home sales were good. Durable goods were solid. Consumer sentiment was solid. there was a lot of better than expected economic data. And if that had been the case, really at any point in the last year and a half, you probably would have been spending the week talking about bonds and Fed hikes. But instead, of course, we're talking about artificial intelligence, because there is perhaps the most dramatic and really profoundly concentrated injection of bullishness that really has ever happened since, with the exception of like COVID, where you saw all these stay-at-home stocks go nuts. But even that was a much more broad, indexed-wide, IPO, SPAC-wide, tech sector-style move. This is on Thursday after NVIDIA's earnings, literally just like the most extreme, concentrated market cap movement that I've ever seen, and I think a lot of people have ever seen. And when you had a company the size of NVIDIA rallying 25% after its report, is just really incredible stuff. And a guidance that the company gave that seemingly justifies it, and really got everybody's attention. And now it's kind of casting this new tech theme of artificial intelligence as sort of the saving grace for a new bull market to sort of formally bring us out of the funk that the stock market has been in since COVID ended, and inflation's been the main issue. So inflation took a big back seat this week to artificial intelligence and the tech rally.
So, okay, so call me, I'm not a doubter, but, I know that the market kind of moves on, in my opinion. This is not, I'm not speaking for you. I'll get your input in a second. But, I feel like we go through these flavors. And, we had the tech bubble, not the tech bubble, the COVID, the Zoom, I'll call it the Zoom bubble or the Zoom growth.
Exactly.
Yeah,
that's a good way to describe it.
Yeah, Zoom growth. I don't want to call it bubble because that's negative, but I'm just saying,
it absolutely was a bubble.
But
COVID, Zoom, stay-at-home stuff was a giant bubble that has since popped. Those stocks are down 80%.
Yeah. Now, artificial intelligence, everything that I read, Oliver, everything in every industry, every paper, AI. And by the way, I want to get your first. I want to ask you: Is this more market hysteria around a particular thing, like AI? And then I want to get your reaction to the deepfake photo that you and I didn't have a chance to talk last week. I think you were traveling and had some other things going on. But the deepfake photo at the Pentagon that moved the market. So let's.
I don't even know about that.
Oh, okay. Well,
I think I was out of town. I must have missed that one. I'm just glad you said you didn't say it's a deep fake photo of me doing something.
It was a deepfake photo of Oliver Rennick on the TD Ameritrade Network saying bye, 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 bye. No, but in all seriousness, I mean, does this feel remotely similar to some of the other flavors?
For sure. Yeah, it definitely does. There's certainly a lot of truth to that, because what's really important here is that the advances this is going to make in services and software are certainly real. That's what kind of makes this particular moment really interesting, because the AI breakthrough has a lot more actual purpose and meaning than blockchain or metaverse, or even some of the home stuff that people try to tell us was going to be so permanent and irreversible. And of course, we heard blockchain was going to change the world. It didn't do anything except just bring us a new type of, fraud and scam and all the companies that sold us that. And then there was the metaverse that was like just kind of a marketing rebranding of stuff that already existed. So the AI has much more foundational, real roots of like productivity and potential impact. Now, That being said, how it is realized is very much still up for grabs. What's really important to understand about NVIDIA is that their stock is going nuts because they upped their guidance. So firstly is, most likely they will live up to that guidance, but they do have to live up to the guidance, and it needs to happen in the next quarter. They've pushed up the next quarter guidance because of how much people are already buying. So they'll probably be able to live up to that. But they're also selling that the developers will use to create AI products. So any high intensity AI software, AI driven software service is going to take up a lot of computing power. And so NVIDIA is going to sell these chips that are going to be used for that. So that is, that's like me. Okay, I'm not great at analogies off the top of my head, but that's like me. That's like if you're a single guy and you go out and you build up your wardrobe for all these dates, and then, you still got to get the date, right? Like you can stock up and prepare, which these institutions are doing by buying all these chips and buying all this hardware, but they ultimately have to come up with a service. They have to sell a product. They have to get a buyer. They have to find a customer. They have to make sure that, their whatever limitations may come from a regulatory aspect on AI and stuff. So that is all going to unfold and is going to put a great deal of support into a handful of stocks. But it is right now a handful, and the concentration is extremely focused, where you didn't even really get a big move, in the S&P 500.
Yep.
Interesting, because the Nasdaq's breaking out, but the S&P is still right at 4,200, which is where it was last week, which is where it was the week before that. Now it's at the very high end, and it does kind of look like it wants to make a move, but it is not extending to the rest of the market, and that is definitely an important thing. And then the last part I would say to this that's probably more important than what I've already said is that in the background of all of this throughout the last 3 months, you've had basically a stimulative effect that's been going on in markets since policymakers stepped in to rescue the regional banks. There has been basically a floor of support put under markets as liquidities come back in and people priced in Fed cuts. There has been sort of an implicit stimulus because regulators prevented a fallout from the regional banks. And then the, of course, sort of organic credit crunch from regional banks never happened. Mm-hmm. So in the background of this, there's been a lot of valuation expansion that's happened without any earnings growth. So long way to answer your question is it's still primarily the 6-month move in stocks up off the lows is almost entirely valuation expansion and speculation, with the exception of the last 24 hours in NVIDIA when they upped their guidance.
I guess I'll just put this out there, and you can react in for like 30 or 45 seconds. But I kind of feel like what is artificial intelligence? You and I have had these conversations that before about AI, but what is artificial intelligence, and is it just a brand? Meaning, like how sustainable investing, that was a big deal for a while. It seems to have retreated a little bit in terms of capturing the same inflows, but everyone and their mother started creating sustainable investment funds, and then you had allegations of greenwashing, and how do you measure whether someone has a sustainable investment or not? And to me, as a guy who's been in you follow the industry
analogy
for a long time, if and been in the retirement and financial services industry for 30 years, it just feels eerily similar to that. I don't want to poo-poo it because I don't think anything should be poo-pooed. I think you need to vet it, but I want to get your reaction to that in about 45 seconds.
I think that's a pretty good analogy, actually, because a lot of it is marketing in a way. There were a bunch of ETFs on Thursday that are labeled robotic ETFs and automated ETFs, and then they didn't even rally because they were to the handful of companies that actually are making this AI breakthrough. So every company right now is basically spinning their business as AI. And that just tells you that people, that there's obviously a lot of exaggeration happening. No question about it. There's going to be some companies that really are able to deliver some really innovative new products from this. That is absolutely the case. It's probably the most realistic hype train we've had over the last 3 years. It's a hype train that's going to lead to some stuff, but it still is a hype train. It's not bogus blockchain. It's not metaverse mythos. It's the real deal, but it still is going through a lot of hype.
Yeah. Well, I can vouch for the TD Ameritrade Network and the Broadcast Retirement Network that there's no AI here in terms of it's actually an Oliver Rennick. It's actually a Jeffrey Snyder in front of the camera doing the analysis. Oliver, we're going to leave it there. Always great to talk to you. Thanks for popping by. Expert analysis as always, and don't forget to catch him on the TD Ameritrade Network. Enjoy the rest of your weekend, my friend, and we'll talk to you again very soon.
Yeah, thanks, man.
Bye-bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, or visit our website, and of course, all of our streaming partners. We're not back again tomorrow. It's Memorial Day, but we'll be back on Tuesday, May 30th, with a very special guest. You're not going to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.